I think they're completely wrong. I think they're correct in that the economy is weak, but it's not going to reduce inflation. I think, if anything, the next recession is a catalyst for a leg higher in inflation.
In this crucial video, Peter Schiff delves into the ominous signs of an impending economic collapse. With banks on the brink of failure and the Federal Reserve's actions under scrutiny, Schiff provides unparalleled insights into the intricate relationship between weak economic data, inflation, and the potential fallout. Uncover the startling truth about the Fed's role, the dire consequences of excessive debt, and why the markets might be misreading the signs. Get ready for an eye-opening journey into the heart of our financial system's vulnerabilities.
I think the main reason the stock market is rallying, other than just all the hype around AI, some of which is probably not hype, but a lot of it is being excessively priced into the market. But I think it's all the weak economic data that continues to come out, particularly out of the manufacturing side. But I think the investors are looking at all this data and concluding that the Fed is done hiking. And even if it's not done, there aren't many hikes left. And the data is so weak that the markets are starting to price in cuts. And it's the expectation of rate cuts that I think is responsible for the market. And I also think investors are concluding that even if the Fed's rate hikes are not enough to reduce inflation, that a recession will do the Fed's job for it. That if we finally get a big downturn in the economy, particularly in the labor markets, that's going to bring the inflation rate down to 2% or lower. And so the markets are, excited about that and starting to price that in. But I think they're completely wrong. I think they're correct in that the economy is weak, but it's not going to reduce inflation. I think, if anything, the next recession is a catalyst for a leg higher in inflation, as much larger budget deficits result in even more money printing and a real return in earnest to quantitative easing. In fact, I think that just the widening budget deficits and the explosion in the net interest cost to the government is going to cause the Fed to step up the money printing. So I think it's going to be stagflation. It's going to be a weaker economy, but much stronger inflation. And that is not a positive environment for the markets, particularly a lot of the growth-oriented type tech names. The types of stocks that investors should be buying that are really inflation sensitive are the ones that they're still ignoring. Well, first of all, the Fed is not honest. Even if the Fed thought a severe recession was coming, it wouldn't admit that. It would try to put a smiley face on it and hope that positive talk would mitigate the severity of the downturn. But we're going to have a major economic contraction because we have to work off really 20 years of excesses that were the consequence of artificially low interest rates. I mean, the excessive debt and consumption and speculation has come at the expense of serious damage to the underlying structure of the economy. And all this has to be worked out one way or the other. And so it's going to be a very painful process that is going to be elongated by government's efforts to mitigate it and get in the way, because the recession is the market's method of repairing the damage that was done as a result of all the malinvestments and misallocations that were a consequence of the Fed's manipulation of interest rates. But when the government tries to push back against that correction, it just elongates the process and makes it more painful, which is, what we've been doing. Every time we start to see a problem, we slash rates and print money. We just saw several large banks fail, and a lot more would have already failed had the Fed not stepped up and backstopped everything. But that doesn't mean we're out of the woods. I mean, all of the problems that resulted in Silicon Valley Bank or Signature Bank or whatever going under, those problems are there throughout the entire banking industry. All you have to do is think about all of the mortgage refinancings that occurred over the last 5 or 6 years, where you've got all these 30-year mortgages in the threes. That's great for the borrowers, but what about the banks that are holding all that paper? They're underwater. They're losing a ton of money on these mortgages. Think about all the commercial mortgages that were extended, where the collateral has collapsed, where commercial real estate values have been halved or down even more than that. So you have all this negative equity in all these loans that the banks are holding on to. Plus, the banks also have large portfolios of government, treasuries, where they own 10 to 30-year maturities, again, where they're collecting 1% and 2% interest in a 5% environment. So they're losing a lot of money on these loans. Meanwhile, everybody is loaded up with debt. Student loans now are getting close to $2 trillion just there. Credit card debt, record territory. Everybody has debt. Corporations, just went on a debt binge during the era of cheap money, and their balance sheets are at risk dramatically as all this low yielding debt matures into a higher rate environment. And look at the federal government. I think interest on the national debt right now is $600 to $700 billion a year. That's double where it was about a year ago. By the end of this year, it'll be about $1 trillion. By the end of next year, the U.S. government will be paying $2 trillion a year in interest on the national debt, which will be about $35 trillion by the end of next year, headed for $40 trillion, probably in another year or two from there. And that's if interest rates don't even go up. What if rates keep rising? What if they go to 7% or 8%? So this is a huge debt bomb that's going to explode. The banks are losing their deposits because
absolutely
they can't pay interest. And so people are yanking the money out of banks and buying money markets. So they're lending their money to the U.S. government at 5%. And so the banks are losing all their capital, in addition to the value of their loans going down. The whole banking sector is completely insolvent, thanks to what we've done over the last decade or so by loading up these banks with all this long-term, low-yielding debt. We had all these deposit insurance, so nobody really cared about what the banks were doing with their money because it was all insured by the government. But now, though, that people have seen these large banks fail, and the government has said, look, we're not necessarily going to cover your bank if you have more than the FDIC amount. It's a case-by-case situation. We're going to have to evaluate the systemic impact. The message that sends is, if you're a customer of a small bank, a regional bank, a community bank, and you've got a large account, you just better get your money out. There's no reason to leave it there. They can't pay you enough interest to compete with a money market. And what if the bank fails? You may be, SOL. And so there's a huge run, on these banks. So they're all going to fail. And the government, obviously, if it wants to bail out every one of these banks, the only way it can do it is by destroying the value of the deposits because of massive inflation. Because the money to bail out the banks has to be created by the Fed. It's the only way they're going to get it. The FDIC doesn't have any money compared to the trillions of deposits. And so it doesn't even matter if your bank fails. You're going to lose money if you have a bank account, because either the bank's going to fail because the government doesn't bail it out and you're going to lose your deposits, or the government bails out your bank and your deposits lose their value because inflation destroys the purchasing power. So no matter what happens, people are going to lose a tremendous amount as this banking crisis unfolds. The thing Jay Powell, is that he refuses to criticize the government for the deficit spending, which is absolutely his job. That's exactly what he's supposed to do. He claims that, we're independent. It's the government that's supposed to stay out of the Fed, not the other way around. If the Fed is independent specifically so it can criticize the government when it does something wrong, when the government is pursuing excessive fiscal policy, it's up to the Fed chairman to call him out on it. That's exactly what Paul Volcker did. Powell likes to talk about Volcker. Volcker was a staunch critic of the deficit spending during the 1970s. And he called on Congress to not only just cut spending, but he specifically said, you got to cut defense spending, you got to cut Social Security, you got to cut Medicare, you got to reduce these deficits because they're creating inflation, they're undermining economic growth. But Powell refuses to criticize any of these deficits and just says that it's none of the Fed's business. And the Fed is just going to take whatever fiscal policy is presented to it. Well, like, it can't do that. I mean, if it wants to fight inflation, it can't do it unless it's willing to bankrupt the government and just say, okay, well, you're going to run these deficits. We're not going to finance them. But of course, he's not going to do that. He's going to do whatever he has to finance those deficits. He's not going to allow a default. So I don't know if he ultimately has to resign so that he can get out of Dodge. But the markets are just completely oblivious to the reality of what's going to happen. They just think that we could go back to sub 2% inflation. It's impossible. The only reason that we had it for as long as we did had to do with all the lags. But we created all this inflation, and now the chickens are coming home to roost, and they're just getting started. And as we have to ramp up the printing presses again, all they're doing is throwing gasoline on the fire. But the fire hasn't gone out; it's still burning.